Hey, I'm John Agatston, founder and president of John S. Agatston Actuarial Services. We've been working on defined benefit plans for decades and cash balance add-on plans for close to 20 years. We've helped many business owners from a diverse field accumulate millions, sometimes up to $4 million through these plans. We've been asked over the years to explain in a way the business owner can understand. So what we've done is put together a composite story of a particular business owner, we'll call Jim, from the initial proposal through to the final termination to help you understand this. It begins with George, a CPA, with whom we have a client in common with. We'd set up a cash balance plan for this client a few years ago. George likes the fact that he can deduct so much more than just with a 401k profit sharing. The large portion of the contribution, actually well over 90%, goes to this owner. And third, he's had some funding flexibility for bad years to be able to get through. And George thinks there may be other clients like that could benefit from this, so he asked if he could ask me some questions. Of course, I said yes. George's first question is how much can be put away? And obviously there's overall contributions for the company, but just for the owner, we have a table here showing the maximum that could be put away by age. At age 35, you see 68,000, age 45, 112,000. You see the numbers climb to well over 200,000. And in addition to that, I told George he could put money away in a 401k profit sharing, which could be over 50,000 there, depending on the age. And in addition to that, there can be pre-funding, or what's called buffer cushion funding in the cash balance plan, which could add maybe another 50,000 or more, depending. For example, the one person age 50, we're showing 144,000. In certain circumstances, he may be able to be put away closer to 250,000. George's next question is, well, how much you have to put away for the rank and file when you're putting away these big amounts for the owner? And I said generally, it depends on different situations, but generally between 7 and 9%. We show in this little diagram here a typical example. We have 3% going in a safe harbor as part of the 401k, another 3% going in profit sharing, and a final 2.5% in cash balance for a total of 8.5%. George's next question is, does the owner have to be the oldest as he finds in defined benefit plans? And I said, not necessarily. As long as there are a few people who are significantly younger. I gave an example. If the owner is middle-aged, but he has 2 young people out of 8, that'll work. And so it's not necessary for the owner to be the oldest. And I also told him there are even cases where the owner could be the youngest, so it's best for him to ask us ahead of time rather than to presume this will work or not work. George's next question was related to flexibility in funding. He liked the way that the client we had in common was able to contribute a lot less in a bad year, and asked him how much flexibility there is in these plans. And I told George there's not as much in like just a profit sharing plan where you can do almost anything. But for the average business that just has occasional downturn, I find there is enough flexibility. The key things are is we try to pre-plan and fund extra in the early years so there'll be enough of a reserve for a bad year. The second key thing is that there's quick communication from him and a client to let us know if there are changes in goals or revenue or expenses or something where there may not be the cash flow they need, and then we can adjust the plan ahead of time. George next asks, when do we recommend adding on a cash balance plan to pre-existing profit sharing or profit sharing K plan? As you know, with a profit sharing K plan, the maximum that we put away is $53,000 for an owner that's under 50, and that goes to $59,000, age 50 and above. And so it's when we get much above that, like they want to put away 80 or 100, they just can't put it all in the profit sharing. That's when we recommend adding on a cash balance plan. George's next question is, what types of businesses does this work for? Are there any that doesn't work for? And I said, no, there are not really any that it doesn't work for. But mainly we work with closely held businesses with under 30 lives, sometimes even one life. Although we have some that are over 100 lives with multiple owners. The types of businesses could be the professionals, the doctors, the lawyers, construction, different types of small manufacturing, consulting, retailing, etc. Finally, I was explaining to George the concept of extra money and how we build plans by managing this extra money through the qualified plans. And extra money we define as the money that's left over that you can't do anything with. You can't reinvest in the business or whatever. It's the money you have after you've had all your company expenses, the owners through pay and distributions taken what he or she could out of the business. You've reinvested what you could. You've added to the reserves what you could, and there's extra money left over. And so this extra money that the investments happen. To better understand this concept of extra money, we have a table that shows some actual numbers and what happens. For a typical business, we may have gross revenues of 1.2 million. Company expenses for all different things the company needed, 400,000. The owner through pay and distributions to take care of their various personal needs, 300,000. There was a reinvestment in this business for 2016 to buy a piece of equipment for about 50,000, and for future contingencies and future investments, 75,000 was put into reserves. This left extra money of 375,000. This table continues on, showing in 2017 when revenues went up. 2018 was a bad year when not just revenues were down, but there was not any decrease in the various expenses and distributions. Then things picked up in 2019 and the best year was 2020. And we show the list at the bottom of how much extra money was around during those 5 years, with 2018 being the bad year. The important thing for us as the actuary is to work with the cash balance add-on plans to be able to try to match these numbers. Not perfectly, but as the closer we can match them, meaning not forcing the client to put away money they don't have in 1 year and then not letting them take advantage of the money they do have in another year. So the better we can match these, the better off the client will be. 2 weeks later, George was meeting with Jim, one of his CPA clients, as part of the year-end tax planning. And in talking to Jim, George thought that Jim's situation could be a good fit to add on a cash balance plan. So they did a conference call to me about setting up an appointment where they could talk about this further. I said to George and Jim, before we do anything, let's look at some numbers real quickly over the phone and see if this is feasible. That way we save everyone time. If you don't need a plan, if you do, you'll know what to expect. So with Jim's permission, I was able to ask him some pertinent questions. Jim said he had between 300 and 350,000 a year of what we just defined as extra money. Jim's age 51. He expects to retire sometime between age 60 and 63. Jim has 8 employees who would be eligible for a plan, and 4 of them are under age 35. The average pay is about 40,000, and the only other key or family-related person is his wife, who's age 48 and makes $50,000. I told Jim, based on what he told me, I think they could do close to 320,000 between all their plans, of which 290 would be for him and his wife, and there'd be some downside flexibility. Jim loved the numbers and asked, what's the next step? I told Jim those are great numbers. Heck, he's getting over 90% for him and his wife and a huge deduction. As far as the next step, I told Jim we go through certain due diligence. First, we want to get a more complete census. As you can see, the things we need here: birth date, and hire date, and pay and hours and that type of thing. Secondly, we want to make sure that Jim's business is standing alone. That's not a part of a control group or affiliate service group. There are no ownership things where we have to include other people. And thirdly, I'd like to see his 401k plan to just make sure the provisions are okay. And they eventually want to coordinate with the TPA on the 401k plan. And lastly, he would have to get with his advisor to set up the investment. So these are things he needs to do to set up the plan, which Jim did go ahead with. He signed documents a few weeks later and before the end of the year. Jim also wanted to know how long this would take him a year as far as time and what's involved. I said, well, usually about 10 hours a year. You're filing government forms we prepare for you. There's some benefit statements, some notices, and other things we give you to distribute to employees. And you have to prepare year-end data and things like that, and asset information so we can figure out contributions, etc. But actually, I told Jim, because you're already working with a 401k plan, most of these things, such as census and all, are already being done. So it may even take less than the 10 hours because there is an overlap. Before I hung up my phone call with Jim and George, I remembered one more thing and stopped them and says, the other important thing is to get timely communication. There'll be things where your goals will change, cash flow is going to be different. The sooner you let us know that, the more we can be proactive in keeping you on course. And they agreed. 2.5 years later, I got a call from George and Jim. Business had been down for Jim. The revenue had been down. He had some extra expenses. And he was concerned that year. It was April when they called. He was concerned whether they'd be able to meet the usual contribution for the year. I told them, I looked at the numbers and told Jim and George that we could lower the contribution because of all the pre-funding to about $100,000. And I said, now if that's not enough, let us know by the end of May and I could cut back we could do an amendment to cut back your benefit and knock it down lower. I told him, remember, he had 17 more months till September 15th of the next year to meet the $100,000 contribution. It turned out that they did not feel the need to amend the plan, and he was able to make the $100,000 actually long before September 15th of the next year. These plans are a little bit like plane rides. You have the takeoff, that's when we design the plan, things get started with it. There's a turbulence, that's what we saw with Jim 2.5 years later when business was down. And he was able to adjust the flight plan by contributing later, but in plenty of time. And then finally, there's the soft landing. We don't want to fly these planes into buildings. It's important when we terminate them that the assets come down and meet the liabilities, so that takes some planning. And so about 10 years later, Jim gave me a call. And he said that business was good. He was looking to turn over the business in the next 2 years or so. The plan was very well funded. It was actually for the assets were more than the liabilities, but there was still less than where we could go. There was a higher limit we could get to, so that was okay. But Jim wanted to know if he could still put more away. And I said, Jim, I can't answer that question just yet till you answer a question from me. He said, what's that? I said, well, how are you going to dispose of this business? He says, I'm not quite sure yet, John. He says, either I'm going to turn over to my daughter and son-in-law, or I may just go on the market to sell it. And I said, well, Jim, if you turn it over to the kids, you can fund more because you can pass that extra money on to the next generation without any problem. It's actually a pretty good strategy. But if you're going to sell it, you want to be able to terminate and have your assets equal to liabilities. So you really need to be able to figure that one out first before I can tell you how much you can put away. Well, a month or two later, Jim called back to say the kids were not going to take over the business, and he was going to look to put on the market in the next year or so. I said, well, now we should look towards seeing how much more you can put away and still get the money out, which is what we did. Within the year, we filed for termination. Everything was fine. He took the money out, put it in an IRA, and went about looking to sell the business. A few years later, I was talking with George about some other cases, and I asked him, George, whatever happened with Jim? And he explained what happened there. After we terminated the plan and Jim put his business for sale, he was offered $900,000. At that time, he had accumulated $2.5 million in the cash balance retirement, and so he was able to turn down the offer because he thought it wasn't enough. He was able to hold out, actually, and within the next year, he got an offer for $2 million on his business. So I said, George, that means he got $1.1 million more for his business as an indirect result of having the cash balance plan. Plus, since he had $2.5 million as cash balance plan, that represents $3.6 million in direct and indirect additional retirement as a result of that cash balance strategy. Now, if you want to consider a plan for your own business, you can do what Jim did. Get in touch with us, either by phone or by email. You see our information on this page. And we'll ask you questions like how much money is available, how much you want to put away, how old you are, when you want to retire, your ages and pays of the employees. Are there other key people you may want to favor? Those sorts of questions, so we can give you a quick answer, see if things are worth pursuing, and then from there we'll get into more due diligence type things, such as a fuller census and all, and that's how we get started. Hope we can help you.